Then came the rule changes. Margin requirements were raised, aggressively, not before volatility increased when such action might have cooled the market, but after the damage was done. Then again, and then again. This is critical. Margin hikes after a crash don't stabilize markets. They eliminate survivors. They ensure that anyone still holding a position is forced to exit. They prevent dip buying. They drain liquidity. It's the final phase of a liquidation cycle. And this isn't new. We've seen this exact sequence before. In 1980, when silver ran uncontrollably higher, rules were changed overnight. Buying was restricted, leverage was removed, prices collapsed, retail was destroyed. In 2011, silver surged again. Margin requirements were raised repeatedly within days. 5 hikes in 9 sessions. Prices collapsed. Another generation of traders was wiped out. And now, once again, the same tools were deployed. Rapid policy shifts, leverage destruction, emergency rule changes, forced exits, different decade, same playbook. But the most revealing part of this story didn't appear on charts at all. It appeared in the physical market. As paper prices collapsed, physical silver refused to follow. Premiums exploded, dealers sold out, supply dried up, buyers lined up, not to sell, but to take delivery. That divergence tells you everything. Because if silver were truly worth what paper markets claimed, physical supply would have flooded the market. Mints would have been overflowing with metal. Dealers would have been desperate to sell. Instead, they couldn't source it. That means the paper price wasn't reflecting reality. It was reflecting leverage unwinding. And institutions know the difference. That's why miners held. That's why physical buyers stepped in. That's why the smart money didn't panic. This crash didn't destroy silver's fundamentals. It didn't reduce industrial demand. It didn't create new supply. It didn't change the role silver plays in the modern world. All it did was transfer ownership, from emotional traders to patient capital, from leveraged accounts to real balance sheets, from weak hands to strong ones. And that's how you know this wasn't the end of the story. It was the reset. Here's the truth that ties everything together. This was never about silver losing value. It was never about demand collapsing or fundamentals suddenly changing overnight. What happened on Friday was not a market failure. It was a structural event, a controlled purge of leverage executed with precision. The biggest mistake people make is assuming price equals truth. In modern markets, price often reflects pressure, not reality. And on Friday, the pressure came from one place only: forced liquidation. When leverage builds up too heavily in one direction, the system becomes fragile. It doesn't take much to tip it over: a policy signal, a surprise announcement, a rule change. Once the first domino falls, algorithms take over, margin calls cascade, and the move feeds on itself. That is exactly what happened. But here's what matters most. While paper silver collapsed, the real silver market did not agree. If silver had truly lost value, physical supply would have flooded the market. Sellers would have rushed to cash out. Dealers would have been overwhelmed with inventory. Premiums would have collapsed. Instead, the opposite happened. Physical silver became harder to find. Premiums surged. Dealers sold out. Mints struggled to source metal. Buyers stepped in aggressively, not because the price was falling, but because they knew it was artificial. This is the disconnect most people miss. Paper silver is a leveraged financial instrument. It can be created, sold, shorted, and liquidated in massive quantities with very little physical backing. Physical silver, on the other hand, is constrained by geology, mining capacity, refining, and logistics. You can crash paper prices in hours. You cannot crash physical supply. Institutions understand this difference. That's why they didn't dump mining stocks. Mining companies don't sell paper silver. They produce real metal. Their value is tied to long-term supply and demand, not short-term liquidation events. That's why miners only fell modestly while silver collapsed violently. The smart money saw through the move. They recognized it for what it was: a leverage flush, not a demand shock. Now add the margin hikes to this picture. Exchanges raise margins when they fear instability, not to protect traders, but to protect the clearing system. When margins jump aggressively after a crash, it signals stress somewhere in the system, usually a large player or a group of players at risk of default. This is why the timing matters. Margins were raised after the crash, then raised again, then scheduled to rise further. That sequence doesn't calm markets. It forces remaining participants out. It prevents recovery. It ensures no one can easily step back in. That tells us the system wasn't finished deleveraging. And here is the most important part of the reveal. None of this changed silver as fundamentals. Industrial demand did not disappear. Solar panels still require silver. Electronics still require silver. Medical applications still require silver. The global push toward electrification still requires silver. Supply did not suddenly increase. No new mines appeared. No hidden stockpiles were released. Nothing structural improved. All that changed was ownership. Leveraged traders were wiped out. Paper positions were closed. Shorts were covered. Strong hands accumulated. That's why the physical market tightened immediately. That's why miners held. That's why institutions stayed calm while retail panicked. This crash wasn't the end of Silver's story, it was the clearing of the board. And when a market clears like this, violently, suddenly, and unevenly, it usually sets the stage for the next major move. Because manipulation can move price, but it cannot change reality forever, and reality is catching up fast. Now the question becomes personal. What do you do with this information? Because once you understand that price does not always equal value, you stop reacting emotionally, you stop letting volatility dictate decisions, you start watching behavior instead of headlines. Ask yourself this: why didn't miners collapse? Why did institutions hold? Why did physical prices diverge? Why did rules change after the damage? Those questions matter more than any price chart. Drop a comment below and tell me what you're thinking. Are you holding? Are you watching from the sidelines? Or are you starting to question whether this market is really free at all? I read every comment. Your perspective shapes what I investigate next. If this analysis helped you see the bigger picture, share it with someone who was hurt by Friday's move, someone who deserves clarity instead of blame. History doesn't repeat exactly, but it rhymes perfectly. Every major silver suppression followed the same steps: euphoria, leverage, rule changes, forced liquidation, recovery. 3 different decades, same outcome. The miners are telling you something. The physical market is screaming something. Institutions are positioning for something. This story isn't over. Crashes like this don't end confidence. They reset ownership. They remove impatient players and concentrate assets in fewer hands. That's how these games are won. They want panic. They want exhaustion. They want you to believe the price is real. It isn't. Watch what happens next.